Imagine owning a piece of the company that redefined what a car can be. Tesla isn't just another automaker, it's the trailblazer in clean energy, robotics, and AI. But with the stock trading above $400 and a valuation over $1.3 trillion, is it still worth your hard-earned dollars? Or has Tesla's stock price zoomed past reality? Stick around, because today, I'm breaking Tesla down like never before, using exclusive metrics and insights to uncover the truth behind the numbers. Let's dive into the first dimension, growth. Tesla's rise has been nothing short of extraordinary. In 2014, the company generated just $3 billion in revenue. Fast forward to today, and that number has skyrocketed to $97 billion, an astonishing growth of nearly 3,000%. This rapid expansion has been fueled by strong demand for its Model 3 and Model Y, which consistently dominate global EV sales, as well as the strategic launch of gigafactories in the US, China, and Europe, boosting production efficiency and lowering costs. Net income tells a similarly transformative story. Tesla went from years of substantial losses to a profit of $12.7 billion in the last 12 months. However, 2023 brought challenges, with profits dipping 15% year over year. Free cash flow has followed a dramatic trajectory. Between 2014 and 2017, Tesla was burning billions, peaking at a $4.6 billion loss in 2017 as it invested heavily in scaling production and infrastructure. By 2020, it turned positive, generating $977 million, and soared to a record $6 billion in 2022, driven by booming sales and operational efficiencies. Yet in the trailing 12 months, FCF has dropped to $1.7 billion, a steep 72% decline from its peak. This dip stems from aggressive price cuts to defend its market share, rising production costs tied to scaling the Cybertruck and Semi, and heavy investments in gigafactories, advanced battery technology, artificial intelligence, and groundbreaking innovations like Optimus and full self-driving. While these moves pressure cash flow today, they are strategic plays for future dominance. These emerging technologies such as full self-driving aim to transform transportation, potentially turning every Tesla vehicle into a revenue-generating robotaxi. The Optimus humanoid robot could redefine productivity and labor efficiency, while futuristic concepts like the Cybercab signal ambitions to dominate the mobility as a service market. Together, these innovations represent untapped growth engines that could solidify Tesla's leadership across multiple industries. Now let's move on to the second dimension, profitability. Tesla's gross margin has fluctuated significantly over the past decade, reflecting its journey from scaling production to facing competitive pressures. Peaking at 25.6% in 2022, the margin demonstrated Tesla's ability to achieve operational efficiency and economies of scale. However, it has since dropped sharply to 18.2%, falling below the 10-year average of 21.5%. Tesla's free cash flow margin has undergone a remarkable transformation. From deeply negative margins, hitting a low of -58.3% in 2015 during heavy investment periods, Tesla turned positive in 2019 at 0.3%, driven by operational efficiencies and demand for the Model 3. By 2022, FCF margin peaked at 7.4%, reflecting strong cash generation. However, in the trailing 12 months, it dropped to 1.8%. Tesla's return on invested capital has transformed from -14.8% in 2015 to a peak of 26.9% in 2022, reflecting strong profitability and efficient capital use. However, it has declined to 9.6% over the last 12 months. The recent decline in margins stems from aggressive price cuts to defend market share, rising input costs for materials like lithium, and the ramp-up of new models like the Cybertruck. Growing competition from legacy automakers and EV startups has intensified pricing pressures. While challenges remain, I think that Tesla's focus on cost efficiency and vertical integration positions it to stabilize or improve margins over the long term. Moving on to the solvency dimension. Tesla's debt-to-equity ratio has shown a significant improvement over the past decade, highlighting the company's strengthened financial position. From a high of 2.73 in 2014, the ratio has steadily decreased as Tesla reduced its reliance on debt while growing its equity base. By 2021, the ratio had dropped to 0.23, and as of the trailing 12 months, it remains as low as 0.11, well below its 10-year average of 1.39. Tesla's net debt-to-EBITDA ratio has also shown a dramatic improvement, highlighting its strong financial health and cash generation capabilities. In 2014, the ratio stood at 11.85, reflecting high debt levels relative to its earnings. By 2017, this peaked at an alarming 38.37 as Tesla continued to scale its operations. However, the company made significant strides in reducing its debt and increasing its EBITDA, turning the ratio negative in 2020 at -1.87, indicating that Tesla has more cash than debt. As of today, Tesla's net debt to EBITDA stands at -0.76, confirming that the company remains net cash positive, with cash reserves exceeding its total debt. This exceptional turnaround underscores Tesla's ability to generate cash flow, fund its operations internally, and maintain a strong financial position. Now the important fourth dimension, valuation. Tesla's EV to sales multiple has seen significant swings, reflecting changing market sentiment about its growth potential. Starting at 8.9x in 2014, it dropped to 3x in 2018 during Tesla's so-called production hell. It then skyrocketed to an insane 21x in 2020, fueled by its profitability breakthrough and market dominance. By 2022, the multiple had normalized to 4.6x but has since climbed back to 13.2x, driven by optimism around future innovations. Whether Tesla can grow enough to meet these lofty expectations remains an open question. What do you think? Let me know down in the comments, and while you're at it, smash the like button and subscribe to the channel, as it will help me tremendously. Tesla's PE ratio reflects its transition from losses to profitability and high market expectations. It surged to 929x in 2020, driven by initial profitability, and normalized to 31x during 2022 stock crash. As of today, it stands at 102x, showing renewed optimism around Tesla's growth potential in AI, full self-driving, and new products in the pipeline. While the valuation signals strong confidence, it also sets high expectations that Tesla must meet through sustained earnings growth. The fifth and last dimension is the shareholders' return. Since Tesla doesn't pay a dividend, the metrics dividend growth, dividend yield, and payout ratio are naturally rated 1. The number of shares outstanding has increased at an average annual rate of 3.4% over the past 5 years, resulting in considerable investor dilution. That said, it's hard to imagine Tesla investors losing sleep over it, given the company's growth trajectory. Currently, Tesla isn't engaging in buybacks, but its issuance rate has stabilized, helping to mitigate further dilution, a crucial metric that all investors should pay close attention. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 3.0. Now let's move on to Tesla's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Tesla's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case gives Tesla a fair value of $229, suggesting it's overvalued by 43.3%. In the bull case, Tesla could reach a fair value of $534, indicating a potential 32.3% upside. Meanwhile, the bear case values the stock at $88, showing a severe potential downside in the case Tesla doesn't meet its growth expectations. On average, Tesla's DCF valuation points to a fair value of $262, implying a 35.2% overvaluation compared to the current price. That's a severe overvaluation that demands caution. We need to be alert to Tesla's valuation metrics, closely monitor next quarter's growth performance, and pay attention to management's growth guidance. In the next section, we'll dive into the reverse DCF valuation to uncover the growth expectations baked into Tesla's current price and assess whether they're realistic or overly optimistic. Moving on to the reverse DCF valuation method, we can uncover the growth expectations baked into Tesla's current stock price required to generate a 12% annual return, my required rate of return. By analyzing the free cash flow growth rate needed to justify its valuation, we assess whether the market's optimism is grounded in realistic performance or if the stock price is pure speculation. Often, large gaps reveal that the growth expectations embedded in the price are just lunatic. Let's dive into the assumptions and results to see if this method also highlights overvaluation for Tesla's stock. Assuming an exit multiple of 50x in 5 years, the results show that the implied free cash flow growth needed to achieve a 12% annual return is 62.1%. This is an exceptionally aggressive target. For comparison, Wall Street's projected free cash flow growth is 44.8% for the next 5 years, leaving a growth gap of -17%. This discrepancy highlights that Tesla's current valuation assumes a highly optimistic growth trajectory, significantly exceeding what analysts forecast. These assumptions suggest Tesla's stock price is heavily reliant on speculative optimism rather than grounded financial expectations. Achieving such aggressive growth targets will require flawless execution, and without it, the current valuation may be hard to justify. My last valuation model is the expected yearly return. This model illustrates the yearly return you can expect as an investor. In theory, calculating your expected return is straightforward, and here are the assumptions I use. The expected yearly return breakdown for Tesla is as follows. Expected EPS growth is projected at 45%, with a shareholder yield of 0.3%, no contribution from dividend yield, a minus 0.1% buyback yield, and a 0.4% debt paydown yield. On the valuation side, the current PE is 102x, expected to compress to an exit PE of 50x. Combined, these factors result in a total expected yearly return of 32%. The expected yearly return of 32% is an outstanding rate of return, far exceeding my required rate of return of 12%. While there are margin compression pressures due to the expected drop in Tesla's PE from 102x to 50x, the projected EPS growth of 45% significantly outweighs this compression. However, this result stands in stark contrast to the DCF and reverse DCF models, which both indicated that Tesla is severely overvalued. This divergence highlights the complexity of Tesla's valuation and the need for deeper analysis. To better understand the growth assumptions baked into Tesla's current price, I'll likely need to conduct an in-depth assessment using Analysis 2.0, which will provide a clearer picture of Tesla's long-term growth trajectory and investment potential. Now is the time to wrap up everything. We saw that in my 5 dimensions model, Tesla earned a solid final rating of 3 out of 5. The company excelled in growth and solvency, but profitability, valuation, and shareholders' return weighed down the overall score. While Tesla's strengths in scaling revenue and maintaining a strong balance sheet are undeniable, valuation remains a critical concern. The high hopes sparked by Tesla's 5D analysis were tempered by the DCF and reverse DCF models, which indicated significant overvaluation at the current price. The implied free cash flow growth required to justify Tesla's valuation far exceeds realistic expectations, casting doubt on whether Tesla can meet such lofty assumptions. However, the expected yearly return method painted a different picture, projecting an outstanding annual return of 32%, well above my required return of 12%. This result, driven by Tesla's remarkable projected EPS growth of 45%, shows that growth could outweigh the pressures of valuation compression in the long run. Tesla's growth story is anchored in several key drivers. EV leadership, with its dominance in the electric vehicle market bolstered by the success of models like the Model 3, Model Y and the expected $25,000 model. Innovation, including advancements in AI, full self-driving, energy storage, and groundbreaking projects like the Tesla Optimus bot, which aims to revolutionize labor and productivity, and the Cybercab, a futuristic autonomous ride-sharing vehicle that could redefine mobility as a service. Global expansion, supported by gigafactories in the US, China, and Europe, enhancing production efficiency and scalability. Finally, diversification, with products like the Powerwall and Megapack, is expanding Tesla's presence in the renewable energy market, solidifying its position as a leader across multiple industries. However, risks remain. Valuation concerns, as Tesla's high multiples assume near-perfect execution, leaving little room for error. Competition, with both legacy automakers and new EV startups from China ramping up their efforts. Margin pressure, as aggressive price cuts and rising costs for materials like lithium could challenge profitability. And growth expectations, which rely heavily on flawless execution in scaling new products like the Cybertruck and Semi and, more importantly, full self-driving. Tesla is an extraordinary company with groundbreaking innovation, strong market leadership, and immense potential. However, its high valuation demands careful consideration. The contrasting results from the DCF and expected yearly return models highlight the need for a deeper dive. To fully understand Tesla's growth assumptions and potential risks, I'll need to conduct an Analysis 2.0. This will provide a clearer picture of Tesla's long-term trajectory and whether it justifies its current price. What do you think? Are you bullish or bearish on Tesla's future? Let me know in the comments. I'd love to hear your thoughts. And don't forget to subscribe to my channel for more in-depth stock analyses. Stay tuned for the next one.